studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that Sunky died.
Now that we understand the general rules, let's walk through a realistic example and see how the small business deduction grind works in practice. Imagine a successful dental practice owned by Natasha. Her corporate structure consists of two companies. The first company is Barnes Dentistry Professional Corporation, which operates the dental practice and earns active business income from providing dental services to patients. In this example, the operating company generates $400,000 of active business income. The second company is a holding company that owns investment assets. Instead of running the dental practice, this company earns income from investments. In our example, the holding company earns $110,000 of bond interest income. Because these two corporations are associated corporations, the government looks at them as part of the same corporate group when applying the passive income grind rules. This is a critical concept. You cannot simply move investments into a separate holding company and expect the passive income rules to disappear. The passive income earned by the holding company is still counted when determining whether the small business deduction grind applies. Now let's compare the passive income to the threshold. The associated corporate group earns $110,000 of passive income. The government allows up to $50,000 of passive income before any grind begins. That means the group exceeds the threshold by $60,000. And this is the key moment. Because passive income exceeds $50,000, the small business deduction grind is triggered. At this stage, we have not calculated any tax increase yet. We have not reduced the small business limit yet. We have simply determined that the corporation has crossed the threshold and that the grind calculation must now be performed. Think of this slide as identifying the problem. The corporation earns $400,000 of active business income. The associated group earns $110,000 of passive income. The threshold is $50,000, and the excess passive income is $60,000. The next step is to calculate exactly how that $60,000 excess affects the corporation's small business limit. And that's where the real impact of the passive income grind begins to appear. Now that we've identified the excess passive income, let's calculate the actual small business deduction grind. This is where the rules start having a direct impact on the corporation's tax position. The calculation follows a simple formula. Take the corporation's adjusted aggregate investment income, subtract the $50,000 threshold, and multiply the excess by 5. Let's apply that formula to our example. The associated corporate group earns $110,000 of passive income. The first step is to calculate the excess over the threshold. We start with $110,000 of passive income and subtract the $50,000 threshold. That leaves $60,000 of excess passive income. This $60,000 is the amount that triggers the grind. Next, we apply the grind factor. For every $1 of passive income above $50,000, the corporation loses $5 of small business limit. So we multiply $60,000 by 5. The result is a small business deduction reduction of $300,000. At this point, we can determine the corporation's remaining small business limit. Originally, every qualifying corporation has access to a $500,000 federal small business limit. But because of the passive income grind, $300,000 of that limit is lost. When we subtract the reduction from the original limit, only $200,000 of small business limit remains. Think about what just happened. The corporation earned $60,000 more passive income than the permitted threshold. Yet that $60,000 excess reduce the small business limit by $300,000. This is why tax professionals pay so much attention to passive investment income. A relatively modest increase in passive income can have a dramatic effect on the amount of active business income that qualifies for the lower small business tax rate. And remember, we still haven't calculated the additional tax. At this stage, we've only determined how much of the small business limit has disappeared. The next question is even more important. How much extra corporate tax will the corporation actually pay because of this reduction? That's exactly what we'll calculate in the next slide. Now let's see why tax professionals pay so much attention to passive investment income. Up to this point, we've calculated the grind and determined that the corporation's small business limit has been reduced. But what does that reduction actually cost? Let's compare the corporation's tax position before and after the passive income grind. Before the grind rules apply, Barnes Dentistry earns $400,000 of active business income because the corporation has full access to the small business deduction. The entire $400,000 qualifies for the lower small business tax rate. Using the example tax rate of 12.5%, the corporation pays approximately $50,000 of corporate tax. This is the tax result many business owners expect when they hear that their corporation qualifies for the small business deduction. Now let's look at what happens after the passive income grind is applied. Remember, the associated corporate group earned $110,000 of passive income. That passive income reduced the small business limit from $500,000 to only $200,000. As a result, only a portion of the active business income can continue benefiting from the lower small business tax rate. The remaining active business income must now be taxed at the higher general corporate tax rate. When the calculation is completed, the corporation's total tax bill increases to approximately $92,000. Let's pause and think about that. The active business itself has not changed. The dental practice is still generating the same $400,000 of active business income. The patients haven't changed. The services haven't changed. The profitability of the business hasn't changed. The only thing that changed is the amount of passive investment income earned by the associated corporate group. Yet the corporation's tax bill increased from $50,000 to $92,000. That's an increase of $42,000. And this illustrates the true power of the passive income grind. The government is not directly targeting the active business. The government's concern is that corporations can use profits taxed at preferential small business rates to build large investment portfolios over time. By reducing access to the small business deduction, the government limits that long-term tax deferral advantage. This example demonstrates why the passive income grind is considered one of the most significant corporate tax rules introduced in recent years. A corporation can earn exactly the same active business income and still face a dramatically higher tax bill simply because its passive investment income has grown beyond the permitted threshold. And that is the key lesson from this example. Passive investment income can indirectly increase the tax rate on active business income, creating substantial tax consequences for successful corporations and associated corporate groups.